Before we begin today's episode, we would truly appreciate it if you could give our podcast a 5-star review, either on Spotify or Apple Podcasts. It's the very best and free way to help us grow and get our content to more listeners. We appreciate it. Thank you so much. Being an investor isn't so different from being a CEO. At the core, both roles are about allocating capital in the most effective way possible. It's a constant game of opportunity costs. Every dollar spent in one place is a dollar not spent somewhere else. And the best compounders are those that master this game, deciding exactly where each marginal dollar should go and ensuring every decision builds value over time. Or, as Warren Buffett once said, the difference between a good business and a bad business is that a good business is the one where you invest $1 and you get more than $1 back over time, and a bad business is one where you invest $1 and you get less than $1 back over time. Quite simple, huh? After diving deep into Dutch holding company Prosus, we learned a thing or two about its business, but also holding companies in general. Prosus is a company based right here in the Netherlands, but its fate hinges entirely on what happens in China. It owns one of the most valuable tech assets in the world. Prosus is a holding company spun out of Naspers, the South African media group that made one of the very greatest investments of all time, buying 47% of Tencent in 2001 for just $34 million. That stake alone is now worth over $150 billion. However, while Tencent is pretty well known, barely anyone knows Prosus. So let's dive into today's episode, where we give you 3 lessons we learned from analyzing Prosus and Tencent. Let's start with Lesson 1. Great investments don't guarantee great companies. Tencent is one of the most dominant businesses on earth. It owns WeChat, the super app that has over 1.4 billion users and combines messaging, payments, social media, and commerce all into one. It's basically an indispensable part of life for nearly every Chinese consumer. Tencent is also the largest gaming company in the world. Some of the gaming studios they own are Riot Games. They own a percentage of Activision Blizzard. Paradox, Ubisoft. They own about 40% of Epic Games. They own almost 100% of Supercell. They own 100% of Funcom, Sharkmob, and many others. They're also the big player behind PUBG and Clash of Clans. It's a real powerhouse in gaming. Tencent is also building and investing heavily in cloud computing, fintech, and, of course, AI. And this is evidenced by their capital expenditures, which have increased massively from $3 billion in 2023 to over $13 billion in the last 12 months. While this is a massive increase for Tencent, it still pales in comparison to the investments made by American big tech, as Tencent is known to be more conservative and patient. Tencent also possesses what is arguably the strongest of all competitive advantages, the ecosystem mode. This is a very rare type of mode, held by only a handful of global companies like Microsoft, Google, and Amazon. To earn this distinction, a company must have all other modes working together in a powerful synergy, and Tencent fits this description perfectly. It has a formidable combination of network effects, switching costs, intellectual property, regulatory protection, and economies of scale. When you combine all these forces, the result is arguably the most powerful company in China. It is also profitable, it's growing, and it's buying back stock. Management is very good at capital allocation. And yet, despite all of Tencent's strength, if we're being brutally honest, Prosus, the company that owns over 23% of Tencent, is not a great company in itself. If we had to choose, we would pick Tencent over Prosus 99 times out of 100 based on the quality of the underlying business. Yet, as our TDI members can see in our portfolios, we all own Prosus and not Tencent. So why is that? Prosus by itself is just a holding company with a pretty messy structure. Some promising but still unprofitable ventures like iFood or PayU or eMAG, and limited operational leverage. Strip out Tencent, and it's just a patchwork of loss-making internet assets. So what's the lesson here? Just because a company owns something great doesn't make itself great. You can think of Prosus as a wrapper, not as Tencent itself. If the wrapper allocates capital poorly or lacks investor trust, it can trade at a persistent discount, regardless of how great the asset inside is. For a lower quality holding company to be worth investing in, it needs to be great at one thing: capital allocation. And for now, Prosus appears to be proving just that. We've unpacked Prosus and Tencent in great detail for TDI members. From Tencent's reinvestment math to Prosus buybacks mechanics, the risks, and the scenarios where the discount could close faster than expected. If you want the full, written analysis, plus podcast, including financials, competitive advantage, industries, charts, and valuation, consider joining TDI Premium. You can find the link in the show notes. And that brings me to lesson 2. Capital allocation is what makes or breaks holding companies. So let's get to the core of our thesis for owning Prosus and not Tencent directly. Prosus is trading at an approximately, and it varies of course, between 20 to 35% discount. This can be lower as of today, and it can be higher when you're listening to this episode. But that's the discount to its net asset value, or NAV. At times it has been as high as 50 or 60% and as low as 18%. That means investors can buy Tencent for less than it's worth, and we get all the other assets for, quotation marks, free. I mean, that sounds too good to be true, right? Here's how you can think about the discount. Imagine a store selling a gift box. The gift inside is very valuable, let's say a gold coin, and that represents Tencent. But the store is selling the entire box, Prosus, at a steep discount, let's say 30% off. So as an investor, you're getting the gold coin at a lower price and all the other goodies in the box for free. But that discount only matters if the company can actually close it and realize that value. If you can't sell the gold coin, it doesn't matter. So how does Prosus get rid of the discount? Well, through share buybacks. Prosus has launched an open-ended buyback program where it slowly sells parts of its Tencent stake and uses the cash to repurchase Prosus shares at a discount. And this is extremely important for our investment thesis. If this stops, we'll have to reconsider the investment in Prosus. The open-ended buyback program creates a powerful compounding effect. The value from Tencent sales is recycled into buying cheaper Prosus shares. Each buyback increases NAV per share for the remaining shareholders, and over time, this should shrink the discount and boost long-term returns. A Tencent share buyback increases Prosus NAV and the value of its stake by reducing the total number of shares outstanding. Since Prosus' ownership percentage of Tencent remains unchanged or is only minimally diluted by the buyback, its stake now represents a larger slice of a smaller pie. In simple terms, for every share of Tencent that the company buys back, the remaining shares, including the ones owned by Prosus, become a slightly bigger piece of the company. This action therefore increases the value of Prosus NAV per share, hopefully returning in a slightly better return than owning just Tencent. So far this has played out, with a 1.4% CAGR for Tencent and a 4.7% CAGR for Prosus. Both are pretty bad, but there is an outperformance of about 2.5 times. This is what we call a double discount thesis. So what's the lesson here? For a holding company to be a successful investment, it must be an expert at capital allocation, especially in a way that closes the gap between the value of its assets and its own stock price. Let's go to the third and final lesson. Discounts exist for a reason. A discount on a holding company exists for several reasons. The discount is a direct reflection of added risks and complexities. It's the market's way of saying, hey, I don't know about hidden costs, uncertainties, and challenges that come with owning a company through an intermediary, which is the holding company. For a company like Prosus, the discount reflects a few key issues. First, structural complexity. The nested ownership structure with Naspers creates tax inefficiencies and a confusing setup that deters many investors. Second, geopolitical and regulatory risks. The primary asset is Tencent, a Chinese company that operates under the constant shadow of potential government intervention and regulatory changes. Third, historical skepticism. The company's past investments and capital allocation decisions have been a mixed bag, leading to a lack of trust from some investors. This is why a holding discount is not a free lunch. However, markets are not always rational and can often overreact to these risks, either to the upside or the downside. So what's the third and final lesson? The key to a successful investment in a holding company is finding a discount that is unjustified and being actively addressed by management. In Prosus' case, a more focused management team and a large ongoing share buyback program are tangible actions that can narrow discount over time. The real lesson is understanding why the discount exists in the first place and knowing whether you can profit from it or should stay away. Just remember, buying a holding company is a bet on two things: the underlying asset and the capital allocator. That's it for today. Until next time, stay curious, keep learning, and happy investing.